Welcome to The Explainer. Today, we're unpacking one of the absolute most fascinating and honestly kind of contradictory situations unfolding in the tech and finance worlds right now. We're looking at Broadcom, a company that is just experiencing an absolute explosion in artificial intelligence infrastructure success. But right beneath the surface of all this massive growth lies a highly complex, potentially industry-altering contradiction that investors are really just starting to wake up to. So we're going to untangle the reality of this AI financing boom, separate the verified facts from the noise, and look at exactly what's going on behind the scenes. Let's dive in.
Okay, to really get why this matters, we need to start with a jolt. Just look at this terrifying figure, $370 billion. That is a recent estimate from a Bank of America analyst, and it's regarding the potential senior debt that could accumulate inside a Broadcom-related AI financing vehicle by mid-2029. It's a number so incredibly huge, it almost loses its meaning, right? But when a number like this hits Wall Street, it inevitably causes a massive shockwave.
Which naturally leads us to the central question we're framing our entire explainer around today. Is the AI boom actually becoming a financing crisis? You see, the whole AI narrative is rapidly shifting. For the last couple of years, it's been pretty much purely a semiconductor story. Who has the fastest chips, who can supply the most silicon. But as that physical infrastructure scales up, it is rapidly transforming into a massive, highly complex financing story. So before we can tackle the rumors and the debt fears, we have to ground ourselves in the verified reality.
Section 1. Broadcom's Growth Engine.
Just look at the sheer scale of this growth. Broadcom's second quarter fiscal 2026 results show exactly why investors have been literally pouring money into this space. We are looking at a record $22.19 billion in revenue. That is a staggering 48% jump year over year. This completely grounds all the hype we hear about in hard, undeniable data.
And if we break that down even further, you can see this isn't just, presentation hype or empty Silicon Valley promises. The money is very real. Broadcom reported a GAAP net income of $9.31 billion and a record-adjusted EBITDA of $15.2 billion. But here is the absolutely crucial point. They are guiding for approximately $16 billion in AI semiconductor revenue for the next quarter alone. That represents year-over-year growth of more than 200%. Broadcom has totally successfully pivoted from being known primarily for networking into being one of the most critical, foundational suppliers of this entire AI data center build-out. But extreme growth requires extreme capital, which brings us right back to that terrifying number we started with.
Section 2. Debunking the debt myth.
All right, let's peel back the onion on that staggering figure and really look at the divide between viral internet panic and actual financial reality. The myth going around is the misconception that Broadcom itself owes $370 billion in corporate debt. That is simply false. The reality? Analysts estimate a separate Broadcom-related infrastructure financing vehicle could eventually hold that much debt by mid-2029, and that's assuming the massive infrastructure build-out continues at its current projected pace. The debt sits within the financing structure, not on Broadcom's actual corporate balance sheet.
So, if the debt isn't sitting directly on their books, we really have to reframe the discussion. The real question we should be asking is this: how much financial risk does Broadcom actually absorb to help its customers buy these chips? Because they do have exposure. It comes through guarantees and support associated with customer lease obligations. And honestly, that is a much more nuanced and, frankly, a much more interesting question about corporate risk management.
Section 3. The Massive AI Ecosystem.
To understand why these massive financing vehicles even need to exist in the first place, we gotta zoom out. An AI chip doesn't generate revenue in a vacuum. You don't just buy a chip and plug it into a wall, well, unless your goal is to immediately dim the lights in your entire neighborhood. Operating this hardware requires an immense, highly capital-intensive physical footprint. You need massive data centers. You need tremendous upgrades to power grids and highly advanced liquid cooling systems just to keep things from melting down. You need networking gear, servers, land acquisition, and years of literal physical construction. The scale is so enormous that deploying these chips absolutely requires complex, highly structured financing.
And just to prove this isn't some isolated Broadcom situation, Reuters recently reported that Nvidia is pursuing its own separate $500 billion AI infrastructure financing initiative. $500 billion. We are witnessing a systemic, industry-wide shift here. The semiconductor industry is becoming inextricably linked with private credit and infrastructure finance. We aren't just asking, how many chips can you sell anymore? We're having to ask, who is going to finance the massive machines that use them?
Section 4.
The Google diversification factor.
Now, to add a little narrative complication to this whole financing puzzle, Google recently announced a major custom AI chip agreement with Marvell Technology. This deal includes a warrant for nearly 59 million shares, and it could potentially generate up to $120 billion in revenue for Marvell through fiscal 2033, depending on performance. Now, when this news dropped, Broadcom shares actually fell. But let's look closer at the details. Broadcom's TPU relationship with Google continues, and their agreement has actually been extended through 2031. The absolute crucial point to take away here is that Google is not abandoning Broadcom. They're just diversifying their custom AI chip supply chain. It's all about securing multiple pathways in a highly constrained, incredibly competitive market.
Section 5. The real AI risk.
So we've looked at the massive growth, we've debunked the immediate debt myth, and we've examined the supply chain. Now we arrive at what is arguably the most thrilling macroeconomic tension in the AI industry today. It really boils down to a fundamental tug-of-war. The bull case is pretty straightforward. If AI customers are generating huge cash flow, then utilizing massive financing isn't a crisis at all. It's actually the exact mechanism that accelerates global infrastructure deployment. It's a massive win. But on the flip side, you have the bear case. AI hardware evolves at lightning speed. If you build a financing structure backed by computing infrastructure, your collateral isn't a brick-and-mortar building that's going to hold its value for 30 years. It's technology. And the real risk is that this technology might rapidly depreciate and become obsolete long before it ever pays off the massive debt used to buy it.
Section 6. 5 numbers to watch.
So how do we actually evaluate this landscape moving forward and cut through the daily market noise? Here's your checklist. Steps 1 and 2. Watch Broadcom's AI and total revenue to see if that exceptional 48% growth rate actually holds up. Step 3. Keep an eye on customer concentration. Are they getting too dependent on a small handful of giants like Google? Step 4. Watch their financing risk exposure. We need to track exactly how much risk Broadcom is retaining through those massive corporate guarantees we talked about. And finally, Step 5. This is literally the ultimate question for the entire industry. Are customers generating enough actual economic value and returns from their AI infrastructure to justify this insane capital build-out?
And hey, you won't have to wait in suspense for long for the next clue. The very next crucial data point for this entire industry thesis arrives on September 2nd, 2026, when Broadcom reports its Q3 earnings. That's when we're going to see if that guided $16 billion in AI semiconductor revenue actually materializes, and we might get some much deeper insights into exactly how they're managing the complex financing structures driving it all behind the scenes.
The numbers already tell us that AI is growing at a breathtaking pace. But as we wrap up this explainer today, I really want to leave you with this final lingering thought. The hardest question isn't about the silicon anymore. It's this. Can the financial system supporting AI grow just as fast as the tech, without creating risks that eventually catch up with the very companies building it? Keep that question in the back of your mind as we watch this incredible industry evolve. Thanks so much for joining me on this explainer, and keep learning.